Vanakkam. Welcome to this revision video on Ind AS 34 Interim Financial Reporting. The objective of the standard is to prescribe the minimum content of an interim financial report. The standard does not tell which entities should prepare interim financial reports. So that is as per law. So we look at listing agreement and other regulations. So the interim report is evaluated independently, right? It is like any other period. So each period's financial statements this year compared to previous year is a different year. Same way, interim period is also a different period. So it is evaluated independently. And there is a disclosure statement that if this standard is complied with, it has to be explicitly stated. All requirements have to be complied with. So interim financial report can be of two methods. Either you prepare a complete set or a condensed set. So complete set is basically what we do for annual financial statements. Two balance sheets, P&L, changes in equity, cash flow, notes, comparative, and if necessary a third balance sheet in case there is retrospective restatement or application. So if you are following the option of condensed set, you don't need the third balance sheet and you need only selected explanatory notes. And the format also will not be as detailed. What is required is the headings are required, whatever headings are there in the annual financial statements, and the subtotals. All the line items are not required for condensed set. So if in annual it is presenting basic and diluted EPS, same thing has to be done for interim also. So interim should be prepared on consolidated basis if the recent annual statements were consolidated. But the standard is silent on whether you should prepare separate financial statements also if they are presented for the annual financial statements, right? Neither requires nor prohibits inclusion of parent separate statements in the entity's interim report. So the objective of interim is just to provide an update from the last annual financial statements. So when we say significant events and transactions, since the last annual reporting period, whatever is significant, that may have to be disclosed. And there is an illustrative list given in the standard, write downs of inventories, impairment, reversal of provisions, and so on. Now there are some other disclosures, we call them 16A disclosures. So these disclosures, either they can be given in the interim financial statements or incorporated by a cross reference to some other statement. So those statements should also be readily available. We'll just go through some of these disclosures. An explicit statement that the same accounting policies and methods that are followed in the annual are also followed in the interim statements. If the business is seasonal or cyclical in nature, explanatory comment should be given, because in interim the position may be distorted. So throughout the year it may get evened out, but when you present interim it may be distorted, and so you need to give explanatory comment so that the users can better judge. Then items whose nature, size or incidence affects unusually, those items should be disclosed. Then changes in estimates of amounts reported in prior interim periods. Let's say for first quarter you have used an estimate and you are changing that in the third quarter. That has to be disclosed. But the scope is more narrow. In annual financial statements, estimates, changes in estimates which affect current or future periods, they need to be disclosed. So here it is not so wide. Then issues, repurchases, repayments of debt and equity, dividends paid, segment information if Ind AS 108 requires. So these disclosures are similar to the 108 disclosures for annual. Then events after interim period that have not been reflected in the financial statements, right? Those events, if they are significant, they need to be disclosed. Then changes in composition of equity, they need to be disclosed, like business combinations and so on. Then disclosure of fair value for financial instruments. Then if entities become an investment entity or they cease to become investment entities, then relevant disclosures. Then disaggregation of revenue from contracts with customers, that is basically different categories of revenue, those are also required. So once you comply with all the requirements of Ind AS, then you need to make an explicit statement that this interim financial statement complies with all Ind AS. Next, this is one of the most important paragraphs in this Ind AS, periods for which the interim financial statements should be presented. So balance sheet, two balance sheets, end of the current interim period, end of the immediately preceding financial year. It is not end of current interim period, end of current interim period for previous year. No. Okay. End of immediately preceding financial year. Right. Previous year and current interim period ending. So let's take the years 2020 and 2021. And let's say you are preparing interim financial statements for the quarter 1/7/21 to 39/21, that is for the second quarter. Okay. Then balance sheet will be for the period ending 39/21 and the period ending 31/3/21, right? Then statement of P&L will be current interim period, cumulatively current financial year to date and comparatives. So basically 4, right? 4 dates for P&L. For equity and cash flows, it is only cumulative, year to date and previous. Okay. Let's look at this in the slide. So for statement of P&L for the quarter, that is 1/7/21 to 39/21, and year to date, that is beginning of the year to end of the current quarter, and also comparatives for the previous year. This is for P&L. Now, if there is an entity which has a highly seasonal business, it is also encouraged to prepare another P&L for 12 months ending on the current interim date. So that is 39/20 to 39/21 and comparative for the previous year 39/19 to 39/20. Coming to statement of changes in equity, it is only year to date. That is, if you are doing for the second quarter, for the period ending 1/4/21 to 39/21 and corresponding period in the previous year. If it is seasonal business, additionally 1 year ending at the end of the current quarter and comparative for the previous year. Similarly, cash flows is very similar to statement of changes in equity, year to date. Okay, for the interim period, it will be 1/4 to 39 and comparative for the previous year. If it is seasonal business, additionally for 1 year ending at the end of the current quarter. So it will be 39/20 to 39/21 corresponding period for the previous year. So this for entities whose business is seasonal, it is only encouraged, it is not mandatory. So mandatory is only as per para 20. Balance sheet, end of the current interim period, end of the immediately preceding financial year. Statement of P&L will be 4 P&Ls for the quarter corresponding previous year and year to date ending at the end of the current quarter, that is beginning of the year to end of the current quarter corresponding period previous year. So statement of changes in equity and cash flow, it is only year to date, that is beginning of the current financial year to end of the current quarter corresponding period previous year. So for seasonal business, then it is also encouraged for P&L, changes in equity and cash flows to report information for 12 months ending at the end of the current quarter and corresponding period for the previous year. So, materiality should be assessed in relation to the interim period. What is not material for the annual may be material for the interim, right? And we can rely on measurements, estimates to a greater extent in the interim because they are meant as an update to the previous annual financial statements. So, let us say there are 4 quarters for which you are preparing interim financial statements. First 3 you have prepared. 4th quarter you are not presenting the interim financial statements. Instead you are presenting the annual financial statements, right? In that situation there may be a change in estimate from the 3rd to the 4th quarter. So, 4th quarter accounts you are not presenting. So, how do you inform that to the shareholder? That should be informed by way of a note in the annual financial statement. So, change in estimate from the 3rd quarter to the 4th quarter, right, and 4th quarter is not presented, then you have to give a note in the annual financial statements. So, in general, of course, like in Ind AS 8, any changes in estimates have to be disclosed, but for interim financial statements, the requirement is not very broad. So, because as per Ind AS 8, change in estimate that either has material effect in the current period or expected to have material effect in subsequent periods, that has to be disclosed. But insofar as Ind AS 34 is concerned, it relates only to the change in estimate. So, the scope is a bit narrow. We need not break our heads. Changes in estimates that affect current period or expected to affect future periods, you need not give separate disclosures, right? Next, the same accounting policies that were followed in the annual financial statements should also be followed in the interim financial statements. The only exception is if you are going to make an accounting policy change which is going to be reflected in the annual financial statements. Okay, in the next annual financial statements, if it is going to be reflected, then it is okay. Then you can change the accounting policy in the interim. Otherwise, the quarterly accounts should follow same accounting policies as annual accounts. So, here a clarification is given that the frequency of entities reporting shall not affect the measurement of its annual results. This is merely to say that interim is not a substitute. Interim is an update to the previous annual financial statement. So, annual, when you prepare, you are not going to add quarter 1 plus 2 plus 3. No, you are not going to do that. You have to analyze independently for the annual financial statements, right, and then present. Some examples are given. So, if you have recognized a write down in inventory and you want to reverse the write down, okay, then you will follow the same criteria that you will do for the annual financial statements. Or if you want to recognize an asset, then you'll have to check whether it's meeting the definition at the end of the reporting period. We don't defer recognition of asset otherwise. Income tax expense and some other items. So, this is what we have to keep in mind. So, what is required is a weighted average annual income tax rate. So, first quarter you are preparing financial statements. So, you are getting some profit. So, what income tax rate should you apply to create provision? You have to calculate weighted average annual income tax rate. You have to estimate what that's likely to be based on the slabs. This year what you are likely to pay, you have to estimate, and based on that you have to calculate. So, suppose for 1 year you make a loss, for 1 quarter you make a loss, second quarter you make a profit. So, how will you calculate? Will you calculate deferred tax asset for first quarter and then defer? No. Okay. So, here how we do is, here it recognize a tax saving in the first quarter itself. Okay. And second quarter, when you incur, when you get a profit, you have to show a tax liability. So, that is how we apply this concept of weighted average annual income tax rate. So, that is, if you are going to expect that for the year you are going to make a profit, first quarter you have made a loss, then you won't carry forward that loss and set off and all. Okay, you don't recognize DTA in first quarter and then reverse it in second quarter. No. So you have to show a tax saving in the first quarter interim, because you are expecting for the annual financial statements that you are going to make a profit. So depending on what you are estimating, accordingly you will have to calculate. Of course, if you have made a loss in the first quarter and the entire year also you are going to expect a loss. So and end of the year in the annual financial statements, if you feel you are going to recognize a deferred tax asset, then of course in the interim, instead of recognizing current tax saving, you will have to show deferred tax asset. Okay. So it depends what is the expectation, and then accordingly you will have to calculate the income tax expense. So let's now quickly go through some examples that were adapted from the International Accounting Standard 34 guidance material, and these examples are also there in your study material. So employer payroll taxes and insurance contributions, they are assessed on an annual basis, right? So we have to estimate an average annual effective payroll tax or contribution rate and apply that to the interim period values. So that's why you have to calculate. So you may not have met the threshold in the first quarter, but that is what you may estimate for the entire year. So based on that you have to calculate. Then, so remember the same principles as for annual are followed for interim, only for things like income tax and all this payroll and any other values that are dependent on the annual values. So you may have to estimate, you may have to think what is it going to be for the annual, what rate, and then use that rate. That is a simple principle, but otherwise you don't have to really break your head. So when you look at major planned periodic maintenance or overhaul, for annual what will you do? Will you recognize a liability? So it is not mandatory. Planned periodic maintenance or overhaul is not legally mandatory generally, right? So unless there is a legal or a constructive obligation, you are not going to recognize a provision. If there is a legal obligation or a constructive obligation, then yes, otherwise generally you will not recognize, right? Same way for provisions also. There has to be an obligation, then only you will recognize a provision in the interim financial statements. Year-end bonus. So this is interesting. So this also principle is of course the same. So bonus may be discretionary, contractual, or based on historical precedent. So if there is a legal obligation or past practice that will make it a constructive obligation and the entity will have no realistic alternative, then you will recognize that bonus. You should be able to make a reliable estimate, right? Similar principle for variable lease payments. So contingent payments that may be based on annual sales, and there may be an obligation in the interim period itself. So if you feel that say for example, so annual sales target is say 10 crores, and in the interim period, first interim period, you have touched say 4 crores, then most probably you will meet that annual target and you may have to pay contingent rent. Okay. So even though the obligation has not arisen in the interim period, right, because target is not yet met, it's going to be met, most likely it will be met, so you have to provide, right? So this also can be grouped in the category of income tax expense, payroll tax, right? Anything which is assessed on annual basis, you have to estimate that rate. Intangible assets, definition and recognition criteria same as annual. Then vacations, holidays and other short term compensated absences. So if it is accumulating, okay, whatever you expect to pay in the next period, you have to recognize. If it is non-accumulating, you are not going to recognize that expense. Of course, even accumulating, if it is used in full, then it is not going to be carry it forward to the next year. In that case also you will not provide. Then, so planned costs like charitable contributions, training costs, these are all discretionary. We don't recognize expense or liability. So income tax expense, as we just discussed, we calculate estimated average annual effective income tax rate applied to the pre-tax income of the interim period. So rate is annual. So if annually you are going to pay tax, even though in the interim you get loss, you should apply that rate to the pre-tax income, which may be a loss also, right? So the tax structure may be progressive like a slab based system. Then also you calculate what slab you are likely to fall under and then calculate the rate. You have to include the impact of enacted or substantively enacted changes. All this is there in Ind AS 12. Jurisdiction wise also you can average it. Okay, if you can apply a separate rate to different categories of income like capital gains and business, and separate rates for jurisdictions, then well and good. Otherwise you can take just a weighted average of rates across jurisdictions and across categories of income. Then, so if you are anticipating or there is a contractual purchase price change that has to be given effect to, that can be given effect in the interim statement. Okay, so it has to be contractual, that is on reaching a certain level of annual transactions, the rate may reduce. So for example, you buy in bulk, so whenever you reach that bulk value, they will give you a discount not only for future purchases but also whatever you have made till date in the current year, and then send you a credit note for that, right? So it can be anticipated, because again interim is not a substitute. Interim is just meant to give an update. It's a supplementary to the annual. Okay, so for the purchase price that the supplier is likely to charge you for that year, you can estimate what is going to be your annual purchases, then what rate will apply to me, purchase price, and then apply that only to the interim period. So in effect, give effect to any rebates that you are likely to receive. Okay, of course it has to be contractual, it cannot be discretionary, right? Then it is not anticipated. So if the supplier has a choice, then we are not going to anticipate it. So when we calculate depreciation, we are not going to anticipate assets that we are going to purchase. Okay, say first quarter, you have to calculate depreciation only for the assets you had in that first quarter. You will not say, okay, for the year I may buy some more assets, let me calculate depreciation for that also. So that doesn't make sense, because only when you buy asset from that date only you are going to calculate depreciation, right? So this is just a clarification. Nobody is going to do this, but it is there, right? In your study material also this example is given. And then inventories, same like how we do for annual. Explanation is not required here. Just one special point is that manufacturing cost variances should be disposed of in that interim period itself. We don't defer the variance, because then it may get measured substantially above cost or below cost. So we don't want that. We give effect to variances by the end of the interim period. So coming to foreign currency translation gains and losses, we take the average and closing rates for the interim period, and stock taking and valuation procedures may not be required at interim dates, right? It's enough if you just make estimates. So maybe you can just reduce, for example, reduce from sales, you reduce the profit element, you will get cost of goods sold, and you adjust it with opening and purchase, and you get value of the inventory. That will be the cost of the inventory. So that also is acceptable for interim alone, not for annual. Then when you engage experts to calculate provisions, actuarial estimations or other experts, let's say like environmental expert to assess the environmental impact and what provision you may have to create. So in such cases, you don't have to do that for the interim. So you can just take the values from the previous annual and then make just make updates. Same way pensions also. Pensions generally we get actuarial valuations. Just make an update. Okay, you don't have to again go for an actuarial valuation. So when you take the help of legal experts for contingencies, same principle. Okay, just make an update. You don't have to again get their opinion for the interim. Intercompany reconciliations we do at a less detailed level, maybe at the group head level, not maybe the line by line item level, right? So that is enough for interim. So let's revise some questions. So in this question, there are two parties, X Limited and Y Limited. X Limited is the seller, Y Limited is the buyer. So the terms are that if the buyer Y Limited purchases more than 200 units per year, the unit price will reduce. Normal unit price is 1000 per unit. If Y purchases more than 200 units, then unit price will reduce to 900 per unit. So for the quarter 36, actual sold is 80 units and expected is 240 to this customer. So what is the sales to be recognized? 80 into 1000 or 80 into 900? So the answer is 80 into 900. So the point is, interim financial statements are not prepared as an independent accounting period. They are part of the annual financial statements. So for the year, it is expected that 240 units will be sold, more than the minimum 200 units. So even though for the interim period, we have not touched that threshold, we expect to cross that threshold for the year. So therefore, the price per unit for more than 200 units, 900 units, that only should be considered while recognizing the revenue, right? The same holds good for the purchaser also. So insofar as the computation aspects are concerned for tax for the interim financial statements, so these are the steps that we follow. At the end of each interim period, so let's say we are looking at the year 2025-26, at the end of each interim period, that is June 2025, period ending September, December 25. So at the end of each interim period, what we do is we think what will be the annual accounting profit. So we think what will be the profit for the whole year. Then what will be the annual tax profit after adjusting any deductions that we expect to receive. Then what will be the annual tax? So this analysis of annual accounting profit, tax profit and annual tax we are doing for each of the interim periods. So first interim period also we will do this analysis. Second interim period also we will do this analysis. And then we calculate what will be the weighted average tax rate. That will be the estimated annual tax divided by the estimated annual accounting profit. Please note that for interim financial statements, we calculate the tax rate as a percentage of the accounting profit. Therefore, the carrying amount of the tax provision should be the accounting profit to date into the weighted average tax rate. So if we are at the end of the second quarter, we are here now. So whatever is the accounting profit for the first 2 quarters into the weighted average tax rate. So normally the provision for current tax is tax profit into tax rate, but here we are doing accounting profit into weighted average tax rate. That is because we are calculating the weighted average tax rate as a percentage of the accounting profit. So that is why we make this slight adjustment. And another point is this tax rate has to be calculated separately for the different types of income. For normal income, we have one tax rate. For special income, we'll have another tax rate, right? So the important point is this analysis has to be done for each interim period. So if this weighted average tax rate changes, the estimate changes in each of the interim periods, then it will have to be recalculated. So the balancing figure of the tax provision will be charged or credited to P&L as tax. So let's revise the test your knowledge question 2 from the study material. So the estimated gross annual income is 33 lakhs and it includes capital gains of 8 lakhs. So this they are estimating. That is, this is the first value, annual accounting profit, right? And then it is mentioned there is no difference between estimated taxable income and estimated accounting income. That is the second step. Annual tax profit is the same as the first step. So first quarter, second, third quarter and fourth quarter values are given, and the capital gains is estimated to arise in the third quarter. Tax rates are given separately for capital gains and other income. So it's quite simple. So when we calculate the weighted average tax rate, that will be annual tax, that is 5 lakhs into 30% plus the balance. So 33 minus 8 is the other income, that is normal income. From that you subtract 5 lakhs, that is the balance income on that 40%. So the tax comes to 1,50,000 plus 8 lakh, that is 9,50,000 divided by 25 lakhs, that is the annual accounting profit estimated, which is the same as the tax profit. So we get weighted average tax rate as 38%. So this is the breakup of income for the 4 quarters. So on this other income, we calculate at 38%, and for capital gains, we calculate at the special rate, that is 12%. So these are the this is the tax provision. Now in this particular illustration, since the estimate of weighted average tax rate is not changing for each of the quarters, we are directly calculating the tax expense. Otherwise, what we would have done is we would have calculated cumulative. If the estimate changes or if the weighted average tax rate changes, cumulative profit to date we would have calculated. That is 8 plus 7, 15 lakhs. 15 lakhs into 38% minus the previous period provision. That's how we would have done. But this is a simple illustration, so that's why all that has not been done. Now what if there is a loss in one of the quarters, one of the interim periods? Should we calculate a tax saving in that case? Yes, if it is for interim financial statements. For annual financial statements, we cannot have current tax saving, we can only have deferred tax asset. But for interim financial statements, current tax also that can be a saving, right? So because interim is part of the annual. So in illustration 1, the first quarter profit is 60 and expected loss is 15,000 in each of the subsequent quarters. So the weighted average tax rate is first calculated. So that comes to 20%, and then for the first quarter there is a charge, P&L is debited, and for the remaining quarters, because there is a loss, a tax saving is calculated. This is another important point for interim financial statements. So let's just go through one more illustration for tax. So in the second illustration, there is a carry forward loss of 600 lakhs and 900 lakhs profit for each of the quarters. So what is the first step? Accounting profit, estimated annual accounting profit is 3,600 lakhs, 900 into 4, right? What is the tax profit? That is 3,600 minus this carry forward loss of 600 lakhs, which we are going to set off. So 3,000 lakhs is the estimated annual tax profit. On that, what will be the tax? 3000 into 40%, that is 1200 lakhs will be the estimated annual tax. What will be the weighted average tax rate? This value divided by the annual accounting profit, that is 3600 lakhs. So 1200 by 3600 is what is done. We are getting 33.33%. This we apply to profit for each interim period. So 900 into 33.33, that is 300 lakhs for each quarter. Next, let us revise illustration 4. So illustration 4 involves Ind AS 2 as well as Ind AS 34. Now in Ind AS 2, we saw that while absorbing overheads, we have to consider the normal capacity or the actual capacity, whichever is higher. So in other words, over absorption is not allowed as per Ind AS 2, because that would amount to the stock being valued above cost. So in this example, overheads is 5 lakhs. So if we take the normal capacity of 1 lakh units, we end up absorbing more when actual production is higher. So in order to avoid this, Ind AS 2 tells us to adjust the absorption rate so that closing stock is not valued above cost. So this adjustment of the absorption rate applies to annual financial statements. Insofar as interim is concerned, if we expect the actual production for the year to be higher than the normal capacity, only then we will make the adjustment. In other words, for interim financial statements, we don't adjust the absorption rate on an interim basis. So we think at the end of each interim period, just like we do for tax. At the end of each interim period, we check what is likely to be the annual tax and then calculate the weighted average tax rate. Same way, at the end of each interim period, what is likely to be the absorption rate? Okay, will it require an adjustment for the year? If yes, only then we will adjust. So it is not done on a period to period basis. When we prepare interim financial statements, we adjust the absorption rate based on annual basis, right? So with that concept in mind, let us now revise illustration 4. So fixed production overheads for the financial year 10,000, normal expected production is 2,000 metric tons. No quarterly seasonal variations. Normal expected production for each quarter is 500 metric tons. So based on this, we will calculate the absorption rate, that is 10,000 divided by 2,000, 5. At the end of each interim period, we should check what is likely to be the actual annual production. If we feel actual annual production is likely to be less than this, then for the year it will result in under absorption, which is okay. But if it is likely to be more than this, so if say at the end of the first quarter we feel okay, we have produced a lot of units and we have sold also, demand for our product is increasing, so we may end up producing say 3000 units by the end of the year. If that is our estimate, then we will have to revise the absorption rate, otherwise we won't revise, right? So nothing of that sort is mentioned in this question. Actual production achieved in the first quarter, second, third, fourth quarter, all these values are given. Total is given as 1900. So there is no information about any expected increase in the annual production at the end of each quarter. Therefore, we will not change the absorption rate. Okay. Calculate the allocation of fixed overheads for all 4 quarters. Now, of course, if this data related to the year, okay, let's say expected production for the year is 500 and first year 400, second year 600. So second year our actual production is more than the normal. Then in that case we will have to adjust the absorption rate, right? But this is not yearly data, this is quarterly data. For the year there is no change. Expected production is 2000 tons only. Normal is also 2000. No change in absorption rate while preparing interim financial statements. Okay. So how will we calculate? So 2500 for the quarter is given, right? So you have 10,000 for the year divided by 2000 tons, 5 per ton, into all these values 2000, 3000, 2500, and then 5 into 4, 2000. Those will be the absorbed overheads, right? No change in the absorption rate. On the study material for the second quarter, there is a note that is given that 500 is reversed by way of a credit. How is this credited? It's automatically credited. Because we don't adjust the absorption rate for each interim period, as we are not expecting any change in the annual estimated production. So we would have absorbed based on 5 per unit. So actual overheads is 2500. We would have absorbed into production, we would have absorbed at the rate of 5 per unit. So assuming 400 units is in stock, how much we would have absorbed is 400 into 5, 2000. Second quarter, what would have happened? We would have absorbed more to the stock. So that's why it's automatically credited, that 500 rupees. That is what they are referring to. It is not an actual entry. So under or over absorption, we don't pass any separate journal entries, because in financial records, it is the actual expense we are recording on accrual basis. So debit is the accrual basis, whatever expense. Only for inventory valuation, we are absorbing. That means what part of the overheads are we treating as part of the inventory cost? Because you have to value inventory at cost or NRV, whichever is less, for finished goods and for raw materials and so on. So that is what is being referred to as the credit here. That means we are absorbing more in second quarter, so that is treated as a credit. It's not an actual credit entry, right? And the last part of this question, will the quarterly results affect the annual results? So what we would have done is, in each of the quarters we would have absorbed at 5 per unit for the actual number of units. So we would have absorbed so much at the end of the year. So for the annual financial statements also, we are going to be doing the same thing. So forget all this interim data. We are at the end of the year, we are preparing annual financial statements. So we know the overheads is 10,000. Normal capacity is 2000. So do we absorb 5 per unit on 2000 or on 1900? We should not absorb for 2000 units, because only 1900 is produced at the end of the year. It will be 1900 into 5 only. The absorption rate is never increased, because then you will end up valuing stock above cost. Okay. So we absorb by using normal capacity or actual capacity, whichever is higher. So for the year, when you prepare annual financial statements, which is higher? Normal capacity is higher. So that is used to calculate the absorption rate. So for the year also, we would have absorbed 1900 into 5 only. For the interim period also, that is what we have done. So it will not affect. Okay. So will the quarterly results affect the annual results? No, it is going to be the same. So that is what is given in the answer, right? So while calculating the tax expense for the quarter as well as the overhead absorption rate, we check what will be the annual and then we calculate the rate. So for tax, what will be the annual tax divided by the accounting profit? For absorption rate, what will be the annual production, normal or actual, whichever is higher, and then absorption rate, right? For everything else, we are not required to do this analysis. So for example, recognition of an expense. We don't postpone recognition of an expense just because in future the income will be higher. Okay. So for everything else, the normal accrual principles and other accounting principles that apply to the annual financial statements also apply to the interim, right? So this illustration, this test your knowledge question 4 relates to a loss in inventory that is to be recognized because of decline in market price. So market price has declined in the second quarter and the question is asking us whether we should recognize this loss, because we are expecting the loss to reverse by the end of the year. Now, we don't postpone recognition of inventory write downs just because we expect it to reverse in future. So, we don't do that, right? It has to be recognized in that quarter itself. That is test your knowledge question 4. So, this principle is also tested in illustrations 3 and 5 of the study material. So, in illustration 3, the quarter wise data is given, and they have given us the expense for a particular quarter, and an opinion that they want to defer this expense of 16 crores because a later quarter has more sales. So, this is given for the first quarter, and the third quarter sales is higher. So, they want to defer the expense to the third quarter. Is that allowed? No, that is not allowed. They have to recognize in that quarter itself. So, in illustration 5, what is done is certain expenses they have not recognized in that quarter. You just have to adjust the net profit, the wrong net profit for all those expenses. Bad debts incurred but 50% deferred, and then exceptional loss incurred 50% again deferred, and then administrative expenses again deferred because fourth quarter will have more sales. So, for the third quarter we take this net profit and then we adjust all these expenses that have been deferred. We reduce them because they have to be recognized in that same quarter to calculate the correct net profit. So, depreciation resulting from change in method of depreciation, that also is not to be deferred. Whenever you are changing the method in that period, you record that additional depreciation, right? So, there is no adjustment to be done there. So, out of all the special cases that are discussed in the study material, the simple principle is an expense or an income that is determined on an annual basis, right? For each interim period, you think what will be the annual position and then accordingly recognize. So, for example, employee payroll taxes that are assessed on an annual basis, then lease payments that are based on a certain annual level of sale. So, you will think at the end of each interim period whether that level of sales will be attained. Then income tax expense, which we have seen in detail. Then purchase price changes, where after reaching a particular threshold you are given a lower rate. So, if you feel annual purchases from a supplier is going to exceed that threshold, you take that into consideration while determining the price. And then for inventories, what is the point where you have to keep in mind? Absorption rate. The absorption rate as per Ind AS 2 is calculated after considering normal or actual, whichever is higher. So, for the year, you see what is the normal capacity, expected actual capacity, determine the absorption rate, right? Only if that is different, you will have to, if the actual estimated annual is higher, you may have to reduce the absorption rate so that it is not measured above cost, right? All the other items, you do the same thing that you do for annual financial statements. So, the additional step is for items which are assessed on an annual basis, like payroll taxes, income tax, then overhead absorption variance, purchase price, okay. So, such items which are determined on an annual basis. So, you make a corresponding step in the interim financial statements. Otherwise, it is just what you do for the annual financial statements, right? No change. And the last point, once you have recognized an impairment loss relating to goodwill in an interim period, we don't subsequently reverse it.